This is the 2025 Forex Trading Empire Mentorship Program Lecture 22. The topic for this lecture is Daily Counter Trend Candle. So in this Daily Counter Trend Candle Lecture 22, we'll be talking about counter trend. Now, I've talked about counter trend, weekly counter trend in the previous lecture. In this lecture, we'll be talking about daily counter trend. Now, why is the daily candle being defined as a counter trend? It means we are trading against the daily buyers. That is, we are anticipating a candle that is against the daily buyers. If price is in an uptrend and price is looking to retrace back to a reference point, that would lead to a trend continuation or maybe lead to a complete reversal, and we are anticipating a down close candle when the daily candle is in an uptrend, then the down close candle we are anticipating is a counter trend candle. So we're going to move to the chart to go through some example, which we have been doing in the previous lecture. So let's move to the chart. On the daily time frame of Euro USD, if you pay attention, you can see the price took out the buy side liquidity. And clearly we can see that the daily time frame is in an uptrend. After the run on the swing high, price created a swing low and a swing high. If we're anticipating a down close candle, which in this example we're anticipating a down close candle, because after price took out the buy side liquidity, you can see two down close candle showing a retracement, and there's no reference point for price to retrace to. Price already took out this sell side liquidity, and the next drawn liquidity is the daily fair value gap. And if you were to place a fib from the swing low to a swing high, you will see that price is retracing back to a discount level. Price is trading back to a discount, moving from a premium to a discount, and moving from a premium to a discount from a swing low to a swing high is a counter trend. So on any candle that price is going to be forming trading down to this daily fair value gap, it's going to be a counter trend candle. Where if we're going to the 1 hour or the 4 hour to look for setups, to look for a retracement back to a reference point that will lead to lower prices, we are having in mind that price is in a downtrend, but it's not great. It's a counter trend downtrend. On a lower time frame, price on a downtrend, but on a daily time frame, price on an uptrend. We're just looking for a short-term retracement down to this daily fair value gap. And the thing you need to be wary about when it comes to counter trend are not the time you can see a clean price action. Most of the price action is going to be choppy, consolidate. You get to see a lot of consolidation along the way, and you need to be more skilled enough to trade counter trend. At first, you can practice on it, but always have in mind and always generalize anytime you're trading a counter trend and pay attention to the results. Find a way to improve your counter trend trading, because counter trend trading is one of the hardest. Apart from a reversal, I think a reversal on the rules that has been given in these lectures, it's very easy for you to trade a reversal. You just need to wait for a 1 hour shift in market structure. But when it comes to counter trend do have a slow price action. Sometimes you're going to make a lot of fake move. The price will retrace back and run the highs. So in between those three trends, between the reversal candle, trend continuation candle, and a counter trend candle, the counter trend candle is the one I find more difficult, and it's the one I don't have a good result trading it. I'm profitable trading it, but it's with a low win rate, a very low win rate, around 30% win rate, trading the counter trend candle. But when I'm trading a trend continuation, I do have a high win rate, and if I'm trading a reversal candle, it's slightly lower from the trend continuation. But in between those three types of candle, the trend continuation is one of the best candle you can trade. If you can dial in on the trend continuation candle, we give you the most good probability of you looking for a trend, because which means the higher time frame and the lower time frame are in sync, they are in the same trend, and there's a high likelihood of that trade playing out. But when it comes to counter trend or reversal, in most cases, most of those setup will fail, which I've talked about the win rates, that a counter trend will have a very low win rate. But you need to add it to your trade plan because you need to understand how it trades and master it and know how to filter the good trades out of those bad trades. That's the only way for you to gain profitability trading the three candle style and to increase your probability and your trade setups. So you can still trade the whole three candle. This is not an advice to say that you stay away from a counter trend candle. You can trade a counter trend candle because you need to increase your trade probability of you getting a setup. Because trading a daily buys or a weekly buys, if you are disclosing that you're not trading the counter trend candle, it's going to lead to some weeks and I can say weeks and months without getting a setup because in some cases price might be on a counter trend for weeks. And if you don't trade the counter trend, which means you're not taking any setup during those times. But if you can learn it correctly, knowing when is the right time to look for counter trend entries, then you can easily trade a counter trend trade. It's slightly the same to a trade reversal, but still have some characteristics that differentiate it from a trend reversal. So in this example, I'm anticipating a down close candle after price took out this swing low. Two down close candles after running the buy side liquidity is a clear indication that price is seeking a liquidity pool to trade to. Price is looking for a reference point. And if you look below this swing low, where's the next drawn liquidity? There's no fair value gap, there's no other block within this price range. The next drawn liquidity is the daily fair value gap, which means I'm going to be anticipating lower prices for price to trade to the daily fair value gap. Looking for price to open, run a buy side liquidity, look for my entry after they run the buy side liquidity or a trade into a 4-hour or a 1-hour fair value gap. Remember, the trend is not that clear, so you need to be careful when using those two time frames. So you can see in this example, price traded lower, took out the swing low, the previous day low, and closed. We are not looking for price to use this one candle to trade directly to the daily fair value gap. We're just looking for a bias to indicate to us that this candle is going to be a down close candle. And during the mostly you target the previous day, and during that process of price trading lower to run out the previous day low, you look for your entry and target the previous day low, or you look for a 1-hour fib extension level, a standard deviation, maybe one standard deviation as your target. Now down to the 1-hour time frame. Remember, make sure you go through both time frame, the 4-hour and the 1-hour, because in my analysis I do use both of them, so it do increase my chances of getting a setup. And I do look at the price from a broad perspective on maybe price is just consolidating on the 1-hour but trying to reference back to a 4-hour fair value gap. Now in this example, price open, traded higher, back to this 1-hour fair value gap. After the run on this swing high, price respected the fair value gap, traded lower, took out the swing low. After the run on the swing low, first price respected this fair value gap. I'm going to make this orange, respected the fair value gap, traded lower, took out the swing low. After price took out the swing low, price did a shift in market structure after expecting this fair value gap. Now this is a clear shift in market structure where you'll be anticipating for price to retrace to a fair value gap and lead to lower prices, which is this lower prices for price to trade lower. So first, we're going to go to the London section because when price traded to that fair value gap, it was during the London section. During the London section, price traded to the fair value gap, failed to run the swing low or even go for the previous day low, traded up, went back to the fair value gap high. Now, this fair value gap is somehow correlated with the 4-hour fair value gap, which I'll talk about it in a bit. I just need to explain the London section on the trade setup I took during the London section from this example. Price retraced to the fair value gap during the London section, which means I'm looking for lower prices. On the 5-minute time frame, on a 5-minute time frame, retracement, swing low, swing high, retracement, price haven't shifted structure, price haven't run out the swing low, price traded higher, then price declined, creating a swing low, running out this low. After a shift in market structure, I'm looking for entry to look for lower prices. Price retraced to this fair value gap to look for an entry. And clearly you can see how price respected the fair value gap but failed to create lower low, and price went back to my entry, did a few consolidation and took out the high. You can see price traded back, took out my stop loss. Now, you can avoid these losses because you need to stick to your plan, which this is like paying a fee to catch the main setup. Now, during the London section, that was my trade idea, looking for price to respect the 1-hour fair value gap. Now, how to use the 4-hour and the 1-hour time frame when trading the daily buys. Before looking at this 1-hour time frame, I already looked at the 4-hour time frame. I already looked at the 4-hour time frame, looking for price to respect a 4-hour fair value gap if price were to trade lower. Where is going to be the next draw on liquidity if price is going to be respecting a 4-hour fair value gap. That brought my attention to this fair value gap. Now, here is the 4-hour fair value gap after the opening price. Price retraces back to the 4-hour fair value gap, going to be making it a green as a 4-hour fair value gap. Now, price respected this fair value gap. Now, the reason I look for an entry just because it was showing a resistance on this fair value gap. Price was resisting from this fair value gap, heading to the previous day low. But price failed to run the previous day low, traded back to the fair value gap, took out the high inside the fair value gap. You can see how price took out the swing high inside the fair value gap during the New York section. Seeing a retracement back to the fair value gap. If you guys remember, the fair value gap haven't led to lower prices or price to run this swing low. To me, this is just consolidation before, because there was a high impact news, there was a CPI news the day price did the retracement back, so the news pushed price higher for price to run the swing high. After the run of the swing high was when I started looking for another entry, lower prices for price to run the previous day low as my next draw on liquidity. So you can see how to use the 4-hour. You just need to have a story and you need to make sure that it's aligned with your bias and use the reference point above the opening price on the 4-hour time frame to look for price to either resist from that area or support from that area. In more lectures, I'm going to be showing you more example where I use the 4-hour reference points. So back to the New York section. Price respected the fair value gap, traded lower, came back to this fair value gap, retracement, respected the fair value gap. At this point, I'm going to be calling this trend a shift in market structure. This is an internal shift in market structure even before price took out the swing low. Price traded lower. Here's a fair value gap as an entry. Where's going to be your target? Now, this setup is the 8:30 to the 10 a.m. setup. You can see after 8:30, fair value gap as an entry. Target lower prices. You can see price did not even close above the fair value gap, even though there was a few consolidation. Price stayed below the fair value gap. And where is the next drawn liquidity? Previous day low. And this is the 8:30 setup. Price traded lower, took out the swing low, retracement, fair value gap, target, swing low. And this is the 8:30 to the 10 a.m. setup. And you can still use the fib expansion to look for more targets. Mostly if price were to trade to your target and it's not up to 2R at the minimum, if not up to 2R as a minimum, you can just use the fib expansion level. Look for maybe a half standard deviation because price is already close to a 2 standard deviation, which will be this swing low. Price retrace to the 50% level, and here's the 50% level. That is, if you were to take any entry and price not up to a 2% R, then you can expand your take profit lower to have a standard deviation. So you can use the standard deviation as how you like. You can target a half quarter of a standard deviation of a half standard deviation, or you can target a half standard deviation, or you can target a full standard deviation. Price respected the fair value gap. Mostly I'll be placing my entry at this swing high where price respected the fair value gap, knowing that if price were to trade higher, I sure don't want to be in the trade. Target to the previous day low, this is a 1.5R. I'm going to be expanding into the half standard deviation to lock in a 2.7R trade, to make it a 2.7R trade. Even before price related to the target, you can see the second entry. If you have missed the first entry, you use the second entry. First target, 2R trade. Fib expansion target, half of a standard deviation, 4R trade. And this is a counter trend. And you can see the consolidation doing a counter trend. Here's an accumulation, manipulation, and expansion below the opening price. And here's the opening price. You can see the opening price. Price stayed above the opening price, took out this buy side liquidity. After running the buy side liquidity, traded lower, shifting market structure, entry 1, entry 2, target 1, target 2. So you can apply the counter trend strategy correctly. It's going to improve your general trade probability and your general win rate if you know how to apply it correctly. And study the counter trend candle more, do more back testing on the counter trend candle. While doing your back testing, make sure you define every candle when generalizing your trades you're taking on the back testing, or when doing your further testing or doing any practicing in the market. Make sure you define the candle before trading the individual candle to know the trend, to know the probability of the trend, which I've talked about. A trend continuation have the best likelihood of having a trade set up because you are mostly going to be finding a clean price action, or mostly if the next drawn liquidity is close to the current price level. Why a reversal trend? Have I can say a medium classes when it comes to a clean price action, and there's a medium chances of you getting a trade set up. Why a counter trend? There's a low chances of you getting a trade set up. So that's why it's good to know the individual candle you are trading, the trend of the individual candle. So when you are using your lower time frame trend, you know which time frame to focus on, and to know when to look for a clear confirmation before taking any setup. So that is all for this lecture. See you guys in the next lecture.